traders and investors. We have a very special guest on the line. It's RJ Hottovy. He's a CFA and consumer strategist for Morningstar. RJ, how you doing this morning?
Yeah, good. Thanks for having me.
Thank you. Well, let's just hop right into this the retail sector and the numbers that have been coming out. They just, for the most part, just been blowing the doors off the streets estimates. Can this continue into the holiday season?
Yeah, I think the results this week do portend a pretty strong holiday season, particularly with the retailers that are traditionally fairly strong in gift-giving categories. I think the numbers we saw from Best Buy, with same-store sales coming in much better than expected. The numbers we saw from Williams-Sonoma were also quite good. I think that, all things considered, and assuming that there's no major shocks in the stock market from here to the holiday season, I think that does, we'll get a pretty good chance for a very happy holiday season this year.
Yeah, and certainly the news out of Japan and, or excuse me, out of China and the ECB is giving a boost to the market here. I just, obviously Morningstar, the ratings are widely followed, by everyone in the world, and I just wanted to tell you, I don't want you to give away the secret sauce, but like when I look at your Alibaba results, reinforce our wide moat rating. I mean, I like that. I hear outperform and best conviction buy list ever. You have to own wide moat rating. How did you come up with that?
The concept of an economic mode is something that we borrowed from Warren Buffett. It was in one of his shareholder letters in the early 90s. And effectively, that's an assessment of a company's business model. How defensible is their business model? What kind of competitive advantages do they have that keep other competitors at bay? The basic premise behind it is that capitalism works and that once the companies come up with a successful business model, other companies will try to replicate that and eventually whittle away the advantages that that company has. Our moat rating effectively tells you how powerful that company's business model is. So when we say a company has a wide moat, we effectively think that it's got at least a 20-year runway of generating excess economic returns. A company we think has a narrow moat has at least a 10-year runway, and a company with no moat is something that may be looking right now, but 5, 10 years down the road may have seen that competitive advantage whittled away. Effectively, we look at 5 things that can give a company an economic moat. There's something called an intangible asset where it might have a brand or a patent or some sort of regulatory protection. The company might be more cost effective than its peers. We look at things called network effect, where the amount of buyers on a platform attracts a wider number of sellers or advertisers. There's something called switching costs, which we see a lot of times in the software industry, where the cost for somebody to switch to another provider is prohibited and protects the seller in that regard. And then something called efficient scale, where effectively the market demand for a product is being satisfied by 1 or 2 players, and the emergence of a third or fourth would effectively dilute returns for everybody. So think of like a racetrack or a pipeline where you just effectively need one of those products. So those are the things that we look at. And so those companies with moats, all things equal, tend to have higher valuations because they have a longer period where they generate free cash flow. So it's a different concept than most of the street takes, but I think our track record has shown that it's a very perspective way to look at the world.
And you go, I mean, and these ratings go all the way. Like a wide is relating to a 20-year outlook. I mean, that's
Yeah,
yeah, wow, that's impressive.
yeah, it's something that obviously a lot of things can change between here and 20 years out. But we're not just looking to the next quarter that the company's reporting. We're thinking about what it is about this business model and what's going to be able to to make this company succeed many years down the road. A lot of times the vision of the street right now is maybe only a quarter, maybe only a couple of years out. While some companies look great the next couple of years, there might be some major structural shifts in the business or the company itself that investors may not be aware of. And so I think that by taking a longer term view, we can sometimes steer people from what might have a short runway and into the more sustainable business model.
And so the worst you have is like a narrow moat. Do you ever have like, jump in the moat or anything like that? Is your lowest is your lowest
uh, the
narrow?
lowest rating that we have is actually no mode, and that just means the company may not be generating If it is generating returns on capital above its cost of capital, the duration of that is pretty short. It's not expected to be sustainable over a long period of time. Now, we do also provide what we call a moat trend rating, which is effectively our assessment of whether the qualities that are discussed about the company's moat are getting stronger or weaker. So in some cases, you have a situation where a company, its moat is a narrow moat but a positive trend, which means those qualities, its brand is getting stronger, or the switching costs behind that model are becoming greater for the customers. Conversely, there are situations where you could also be a negative trend, where the company's advantages are also getting weaker. And so that's how we kind of, try to convey the direction of that mode rating is through this trend rating that you can find on each one of our reports.
Okay, all right. So let's just go to Alibaba. What a hot stock. We had noticed back on the show a couple of weeks ago that there had just been some huge, just steady institutional buyers on the open. We noticed it for like every day for about 2 weeks, or maybe even a longer time span than that. Then lo and behold, the 13F filings come out. The institutions have loaded up on it. It's had a nice run up to 120. I see you have a wide moat rating on it. Could you just give us, your short and long term outlook for Alibaba?
Sure, and you're right. It's been one of the more intriguing stories of the year, Alibaba, not just from a company perspective, just because I think the idea of having both exposure to China's middle class as well as China's e-commerce infrastructure is quite compelling for a lot of institutional investors. But the fact that the IPO was so successful, I think, is also one of the major stories of the year. So we assigned the company a wide moat, and a lot of it has to do with the idea of a network effect, where Alibaba has access to the widest number of consumers in the Chinese market. There's over 300 million active buyers on Alibaba's different marketplaces today, which obviously is very attractive for individual sellers and other large consumer companies that are looking to access the Chinese consumer. Because they've entrenched themselves as having that wide reach, makes it very difficult for other players to come into to this market and displace them. So you have some smaller competitors like a JD.com or even an Amazon, which is trying to get in the market. And it's going to be very difficult for them to, in our minds, to gain critical mass. They might, have some success in, some of the more populated markets, but because Alibaba's reach is so expansive at this point, it makes it very difficult for them to displace them. And so with this network effect, we think that there's also, and that tends to be one of the more longer lasting competitive advantages that a company can amass. That gives them a 20-year, at least 20-year runway in our minds of generating excess economic returns. It doesn't help or doesn't hurt that the company's also got a very cost-effective model. More effectively, it's not investing a lot of capital. Instead, really, it's just more of a marketplace. And so, at the same time, that also provides a nice tailwind from a return on invested capital standpoint as well. Now, how that plays into our valuation, effectively what we do is we look at every company using a discounted cash flow model. And the first 5 years that we're projecting out, we have an average of over 30% top line growth, and then adjusted EBITDA margins improving from the high 40s to the mid 50s over the next 5 years. Now, because the company is a wide moat company, we also apply a stage 2 to our discounted cash flow model. It's effectively a 15-year runway beyond our first 5 years that we're looking at, where we think the company can effectively drive about 8% operating income growth on average over that 15-year period. Now, think about that. The duration of that is very long, and just speaks to the business model that Alibaba's built. And that's effectively, we'll come back, that time period that we look at, all things considered, we had two companies that had the exact same fundamentals over the next 5 years, but then also that one had a moat and one didn't. The company with the moat would have a higher valuation just because of the duration that stage 2 gives. And so Alibaba, just because of the network effect, that's really where we're driving a lot of value in that business.
RJ, Alibaba hit an all-time high of 120 last week, and then it's kind of been trading slightly lower after that. I was speaking with a Wedbush analyst earlier this week that said it's probably that it's been long enough since the IPO that people are starting to take short positions of it. Do you agree with that? And what are kind of the implications for Yahoo?
Yeah, I think that's exactly right. I think that, and we think at this point, as great as the business model is, we think that the market might be pricing in a little bit of a little bit too high, too aggressive of long-term assumptions in the model. I think we have a $90 per ADS fair value on the name right now, and again, that bakes in some pretty healthy growth numbers over a long period of time. I do think that you're starting to see some short positions into the name. I do think that a number of people do think that the shares are overvalued at this point, and that particularly if the company embarks in kind of an investment cycle, and its mobile platform, its increased marketing, some digital content investments, that potentially the margin numbers might continue to go down at least over the next couple of quarters, which could scare some of the investors that got in on the IPO. So I think that you are starting to see some short positions. With respect to Yahoo, I think what it means is I think that they've already taken some of the proceeds from the sale and invested it in some areas too. I think that they still maintain a stake, but I think that they're continuing to weigh their options and what that means, what the proceeds from the IPO means for them.
Just looking at your 10 high conviction purchases that are as made by your ultimate stock pickers, I was looking at them, and a couple at the top, eBay and Comcast have wide moat ratings, but there's actually few with no moat rating, and there's a couple with a narrow as far as Honeywell, Perigo, and Goldman Sachs. So, I mean, I see those stocks are on the list, but having a high moat rating is really not the key determining factor then.
That's more our ultimate stock pickers list is generally kind of monitoring institutional money flows and seeing where investors are flocking to. And that's more of an indication there. All things equal, though, we do have several products that track our moat ratings. We actually have a traded index called the Wide Moat Index, which at any point takes the 20 cheapest wide moat stocks. We rebalance it quarterly, but it's actually a way for investors to partake in our methodology. The ticker on that is actually MOAT, MOAT, and it's been very successful over the years. And it's something that really kind of encapsulates our methodology. So that's one way of doing it. Now, with respect to the ultimate stock pickers, I think it's an interesting balance of some of the more noteworthy names. And to your point, we did see a lot of rotation in eBay, particularly as the stock fell under $50 per share. That's a name that we think, kind of like Alibaba, has a very powerful network effect where you have access to a wide number of users, both on the eBay side of the business as well as the PayPal side of the business. I think each business is a standalone wide moat business. PayPal probably stronger than the eBay marketplaces, but still intriguing businesses as they look to separate next year. So, it is an interesting product that we put out, just kind of taking a look at the money flows, and we try to emphasize which moat names the mutual funds and pension funds are buying at this point.
RJ, I kind of want to switch gears a little bit. We've only got a few minutes left for you. Let's talk about wearables. How do you think wearables are changing the consumer electronics industry? And do you think the Apple Watch can bring it into the mainstream, or do you feel like wearables are already in the mainstream?
I think we're certainly seeing wearables become more integrated with the everyday life, particularly among the millennial audience. And I do think that, much like the smartphone has changed our day-to-day life, there is room for wearable devices. Now, the key question is adoption rate, particularly among the mass audience, and I think that might take a little bit longer. But I do think the fact that you're starting to see integration with smartphones, the new watch products that are on the market from Apple and Samsung, now that they're starting to be integrated with smartphones, that's probably the right way for those companies to start to build ubiquity with their watch products. Now, I think it will take time for consumers to fully buy into these. In our views, it's not going to fully displace, classic watch designs either. So we do like the name like Swatch. We think that's attractive because we think the market's gotten a little bit too presumptuous in the fact that this new technologies might displace it. But I do think we'll start to see increasingly more and more, wearables, particularly, the health and wellness category. We're starting to see more of that. And then, I don't think it's necessarily. I think we've seen some slowdown in some of those sellers at this point, but I think you'll start to see more stable growth over the longer period of time, particularly as more consumers become aware of the benefits of having this, and the companies align themselves with insurance companies too to lower premiums. I think that will find be very attractive to consumers and help to drive the growth of this category over a longer period of time. So do you think there's room for it? It's an interesting category and really be one of the categories to watch for the next few years.
And what about GoPro? Do you have any thoughts on that?
Unfortunately, we don't cover the name right now, so it would be tough for me to comment on it. I know that the IPO was well received, but at this point, we don't offer coverage of that name.
Okay, just general market thoughts here. I mean, we got the big boost from the overseas markets. I know, besides, the information, a lot of great information available on Morningstar. Could you just give some real general advice for our investors and traders out there?
Sure. I mean, I think if you look across the board, and I think I looked at the average for the 1,400 stocks that Morningstar covers, the average price to fair value, so the average where this current price for the stock is trading compared to our intrinsic value, and that's one of the key differences that we do is we don't publish price targets. We publish what we think the stock is worth. We don't try to predict where the market's going with it. We just tell you what we think shares are worth today. If you look at the average price to fair value among the 1,400 stocks that we have right now, it's about 1.03 or 1.04, somewhere in that range, which says the market right now is about 3 to 4% overvalued. And so we think that the market might be pricing in aggressive assumptions across the board. In the consumer space, we feel like right now that actually the consumer defensive names, so the staples companies, are actually 6% overvalued. And we've seen a lot of rotation in those names just because of the dividends that are there, as well as some prospective M&A activity too. We've seen a lot of M&A activity in that space the last couple of years, whether it be Heinz or a number of names like that. And so that potentially, we've seen a lot of rotation on names. The more cyclical names that we cover, they're trading about fairly valued at this point. So there's still some caution whether or not the strong results we've seen out of the retailers this week are going to be sustainable. I think that the best advice I can give to traders and other investors is really, take a fundamental look at the company's business model and understand really, how long a company can defend off its peers. And so I think that's what our moat ratings try to convey. Helps you, decipher which companies are truly can stand the test of time and which ones are more flash in the pan. And we've shown that when the market misprices a name that has a very strong defensible qualities to it, it creates a powerful buying opportunity. So that's really the advice I would be, telling people right now, particularly in a market that looks somewhat overvalued, is to really focus in on those powerful wide moat or narrow moat companies and that seem to be trading at an intrinsic value. A lot of these businesses, oftentimes, the market underestimates their ability to adapt to changing consumer preferences, the technologies, and I think that a lot of times buying opportunities really do show themselves when the market loses favor of them. So that would be my advice right now.
Okay, RJ Hottovy, consumer strategist from Morningstar. You should definitely check out their site. I'm a big fan of it. That's where I like to get my data on all the indexes and stuff. Great information. Thank you. We hope to have you on again.
Thank you.
Thanks, RJ.